Hello and welcome back to the Commodities Trade Institute podcast, your daily breakdown of the global commodities markets and the forces moving them. I am your host, Emily Costa. It is Tuesday, May 5th, 2026. Today we are looking at a world where 60-year-old alliances are dissolving, where gold is consolidating in the face of currency jitters, and where the very infrastructure of energy is being tested by war and neglect. It is a Tuesday that feels like a turning point, so let's get right into the heart of the markets. We begin today in the metals sector, which is currently seeing a massive wave of consolidation and strategic repositioning. In Australia, we have just seen the birth of a new titan. Regis Resources has moved to take over its smaller peer, Vault Minerals, in a deal valued at approximately 10.7 billion Australian dollars. This isn't just another corporate merger, it creates Australia's third largest listed gold producer. The combined entity will oversee 5 operating mines in Western Australia, with a projected output of 700,000 ounces of gold per year. What is fascinating here is the timing. Bullion prices have been on a tear, driven by central banks across the globe scrambling to diversify their holdings away from fiat currencies. This merger is a play for scale, unlocking over $500 million in tax benefits and giving the new company the weight it needs to navigate rising capital costs. It's a clear signal that in a world of geopolitical uncertainty, gold isn't just a hedge, it's a theatre of growth. Meanwhile, in South America, Argentina is making a play to become a global mining powerhouse. Under the leadership of President Javier Milei, the country is seeing the fruits of its new incentive regime for large investments known as RIGI. The Argentine Chamber of Mining Companies is forecasting that mining exports will jump by 49% in 2026, reaching a value of $9 billion. We are seeing giants like BHP and Rio Tinto move in, with billions of dollars in projects already submitted for approval. Argentina has climbed from 12th to 7th in the world rankings for exploration destinations. However, this growth isn't without friction. Recent reforms to promote mining in glacier regions have set off alarm bells for environmentalists and scientists who worry about the long-term threat to water resources. It is the classic commodities dilemma, the urgent need for mineral wealth versus the preservation of the environment that holds it. This theme of shifting power structures brings us directly to the most shocking development in the energy world, the effective end of OPEC as we knew it. The United Arab Emirates has officially exited the group as of May 1st, widening a massive rift with Saudi Arabia. For 60 years, the UAE was a pillar of the cartel, but Energy Minister Sohail Al-Mazroui was very clear this week. The UAE owes it to its investment partners to produce what the market requires without restrictions. They are repositioning themselves as a sovereign, independent energy power, focused on their own long-term strategic objectives rather than Riyadh's quotas. When you look at the numbers, the decline is staggering. In the 1970s, OPEC oversaw 50% of global production. Last year, that was down to 35%. By March of this year, following the closure of the Strait of Hormuz at the start of the Iran war, that figure plummeted to just 26%. The Trump administration's foreign policy has played a massive role here. Between the military forays in Iran and the rapid takeover of Venezuela's oil sector following the capture of Nicolas Maduro, the traditional pillars of OPEC have been left fractured. With the Strait of Hormuz trapped and a fifth of the world's oil and gas supplies stuck inside the Gulf, the United States stepped in to fill the void, becoming the world's largest producer and ramping up exports to Asia and Europe. But here is the catch. The US industry is driven by market forces, not a central committee. Without OPEC's spare capacity to act as a shock absorber, we are entering an era of much higher volatility. We might see more frequent boom and bust cycles, which eventually means more pain for the consumer at the pump. Speaking of energy shocks, let's look at the power grid and the carbon markets. In Venezuela, the situation is dire. Interim President Delcy Rodriguez is trying to jumpstart a $100 billion reconstruction plan for the country's deteriorated electrical grid. But there is a major problem. Nobody knows how they are going to get paid. Executives from Siemens Energy and GE Vernova recently walked away from meetings in Caracas feeling highly skeptical. Only about 40% of Venezuela's generation capacity is actually available, and the thermal plants have been neglected for a decade. In cities like Maracaibo, residents are enduring blackouts of up to 10 hours a day. It is a tragic irony that a country with some of the world's largest oil reserves is currently lit by motorcycle headlights on basketball courts. Across the ocean in Asia, the war between the United States, Israel, and Iran is creating a strange ripple effect in the coal markets. You would expect coal prices to skyrocket, with 20% of global liquefied natural gas supplies lost due to the Hormuz closure, but the rally has been relatively modest. High-quality Australian thermal coal is up about 12.6%, ending last week at $130.81 per metric ton. Why isn't it higher? Because China has turned inward, relying on domestic coal and pipeline gas. However, as we head into the peak summer demand, the math is starting to change. With spot LNG prices hitting $17.80 per million British thermal units, coal is becoming the much cheaper option for Japan and South Korea. If Brent crude continues to hover around $114.44 a barrel, we could see a significant switch back to coal by July. Turning our attention to the ground, the agricultural sector is battling its own set of challenges. In the United States, the winter wheat crop is struggling. The latest reports show only 31% of the crop is in good to excellent condition, the lowest level for this time of year since 2023. Drought and recent freezes in the plains are taking a heavy toll, and moisture stress is expected to continue for at least another week. On the brighter side, corn planting is ahead of the 5-year average at 38% complete, and soybeans are 33%. But the real story in agriculture is coming out of Brazil. Despite some weather-related yield losses in the south, StoneX has raised its forecast for Brazil's soybean crop to a staggering 181.6 million metric tons. That is a 1% increase from previous projections, fueled by higher productivity and expanded planting areas. Brazil's total corn crop is also looking robust, estimated at 137 million tons. This massive South American supply is going to be a critical factor in global food security as Northern Hemisphere crops face weather volatility. Finally, we look at the flow of these goods in the dry freight and export markets. Russian wheat export prices have remained stable at around $238.50 per metric ton, but the volume is expected to drop significantly. Initial forecasts for May suggest that Russian exports could halve compared to April, falling to about 2.5 million tons. This is despite the fact that 97% of their crops are reported to be in good condition. It seems high energy and fertilizer prices are starting to bite. In Argentina, agricultural export revenues fell slightly in April to just under $2.5 billion, though that is still a 23% jump from March as the harvest season picks up. We are seeing more trucks arriving at the ports with corn, sunflower seeds, and the first batches of soybeans for industrial processing. It is a reminder that even as geopolitical rifts widen and energy grids fail, the fundamental business of feeding the world continues, albeit through increasingly complicated and expensive routes. It's a complex landscape, to say the least, from the end of an oil era to the consolidation of gold and the resilience of South American farmers. The commodities world is being rewritten in real time. If you found this episode valuable, be sure to subscribe, share, and leave a review. Find us online at commoditiesinstitute.com.